when I got my real estate license, I knew I wanted to invest. So I'm working with a bunch of investors. I'm looking at all these deals. I'm underwriting every deal I sell. I underwrite it as an investment. And I'm thinking, man, none of these are really that good. They're all just kind of deals or almost deals. And then 2-3 years goes by, and that investor calls me back, says they want to sell. 40% increase in value. They've been cash flowing. It hadn't been vacant once. It's just like hindsight's 20/20 on everything. But time is going to make every investment good one. If you buy it correctly and you can wait long enough, and time will make most investments worth it. Hello everyone, today we have a special video for you guys. We're going to be talking about the real estate market, more specifically the interest rate market as it applies to the Fed rate and mortgage rates as well. And so I've got Trent Braden with Braden Group Realty and Wade Huckabay with All America Bank, and we're going to kind of jump into it here and talk a little bit. Trent and I had a discussion a week ago, I guess, and he was just dropping bombs on me. And I was like, man, this is really good information. And he was telling me that Wade, his uncle, sits on the board of a bunch of banks, helps run All America Bank. Correct me if I'm wrong. And you're plugged into all this, not just what's going on this month or next month, but 24 months out. So what does All America Bank think is coming down the pipe? What can we expect for Fed rate, mortgage rate, all that stuff? Kind of tell us what you guys are seeing.
Okay, so I'm on the board of one bank.
Oh, one bank. He embellished. He said hundreds.
Used to be 3.
Okay.
And and I'm the president of the bank.
Okay.
Chairman currently of the board. So give me the question again, please.
All right. So what are you guys seeing? What are you seeing over the next 12 months, 24 months? The big question as a real estate agent we get is, should I wait for mortgage rates to drop? No one has a crystal ball. What are you guys seeing? We'll talk about the investment side here in a minute, but what are you guys seeing the Fed rate going to be doing soon? Because they're going to meet in a couple days, right, over the next year, 2 years.
Okay, so the Fed meets at the end of January and the 1st of February. So according to a broker, there's a 100% chance that they're going to raise rates, and they expect it to be 1/4%.
Okay.
And so they're trying to raise rates in order to get a handle on inflation. Mm-hmm. And the Fed has control of the short-term rates, but the longer the time horizon goes out, the less effect they have as the market forces take over. So when the Fed lowers or raises rates, it's called the discount rate, which is a Fed fund rate, which is what it costs banks to loan each other money overnight unsecured. And so I look at, when I'm gauging what the Fed might do, I've been told that the market is more accurate than any individual.
Yes.
So right now the discount rate, the target is 4.5, and you add 3 to that and you get New York Prime. Okay. And so New York Prime, which is what the big banks, that's what the lending rate is to their best customers. And so New York Prime tracks a discount rate. There was a time in 2008 when it didn't track it exactly, but it's back on track now. So if you ever want to know what the discount rate is, subtract 3 from the New York Prime. So right now the discount rate's 4.5, and I'm looking at the market, Fed funds futures 3 months from now, and it's about 30 basis points higher. So the market is saying within 90 days, rates will be 1/4% higher. Okay. And now I look at Fed funds futures for a year from now, and the rate is 4.44 rather than 4.5. So the market is saying 12 months from now, the rates will be the same, or maybe 1/4 less a year from now.
So this is the market, analysts, banks, everyone predicting what's going to happen and setting those future rates.
These are people putting their money where their mouth is.
Okay, good.
So, yes, but, for secondary market lending, like most people do when they buy a house, I've been told that closely tracks the 10-year treasury. Right. And as of today or yesterday at closing, the 10-year treasury was 3.44. And so the yield curve's inverted. The 3-month treasury is almost 4.7, but 10 years from now is 3.44. So the yield curve is inverted.
Yeah.
It's opposite of what it normally is.
Okay.
So the market's saying rates are going to be going down.
Okay.
This is the most severe inversion I've ever seen since I've been looking at it.
So the market as a whole, and that's over even a 3-month period as things, it's going to be falling. Is that right?
Yeah. Well, if I look at the 3-month, it's the rate's 468.
Okay.
The 6 months,
Up
the 6 month is 484.
Okay.
But the 10 years, 344.
Yeah.
So I mean, it's over 1% lower on the 10-year time horizon.
Okay.
So what would that reflect in just 2 years from now for the market?
Well, if you believe the treasury yield is an accurate compilation of what the market thinks, so I'm showing a 2-year rate of 415, and right now it's 468.
Okay.
So
Down a half almost.
yeah, down a half.
Okay.
Yep. Yeah, 2-year, let's see, make sure I'm right on that, 4.15, and right now it's 4.68, yeah.
So how do banks on the investment side, how do banks look at this? I mean, do they look at this and set rates, or is it just what rates are at today? What banks are having to trade discount rate at today?
Well, the Fed sets that rate.
Right.
But that's the only thing they can set.
Right.
And so they're raising rates. Now, we talked about that discount rate, which is 3% under New York prime. And according to these talking heads I see on TV, the discount rate has to get up to where the inflation rate is before inflation stops.
Okay.
So inflation was here at 7.5, and then they started raising rates. Now inflation's like at 6.5.
Okay.
And the discount rate's at 4.5. So they're still 2 apart, but you don't have to move this all the way up here. They converge.
Yeah.
And it may stay there for a while because the Fed has insisted we want the unemployment rate to go up significantly because wages are what is driving inflation.
Yeah. Have they set a target unemployment rate?
Not that I know of, but I'm assuming they want the unemployment rate to be around 5%.
Yeah, it shouldn't be. I've read it should not be lower than 4.4. It's an unhealthy. What causes inflation to run a little bit? Yeah.
Right. It's driven by wages mostly.
So Fed kind of rips everyone's head off with 75 basis point hikes all through the second half of 22 to kind of shock the market. And now they're getting more. Now they've seen some reaction, and now they're just kind of chipping away at it to help it keep coming down. Like what's Powell saying is going on, or what are they trying to do?
Well, they're slowing down the increases, but I hear and I am told that when they do an interest rate increase, there's about a 6 to 9 month lag before you can see what the effects of that are. So this 0.25% may be it for a while until that, and they may start waiting to see what the inflation rate does over the next several months.
So when was the first 75 basis point jump? Is that June?
I don't remember.
So we're just now kind of seeing official results of what we've been doing the last 6 months.
Right.
And so this 25 basis point hike, it might be a wait and see after that.
Yes.
Okay.
I would be shocked if they raise rates again on the next meeting. I don't know when it is. I can't remember, but I think they're waiting to see what the effects of all these
massive increases.
Right.
So if it has the correct effects in their eyes, and I know what the market's saying by in 2 years come down, half a point. But do you think, or do people you talk to think that it'll just come down half a point, or do you think it could be potentially more than that? Because I feel like people have been so used to, at least loan rates, for commercial loans, which is mainly what I do, the 4.5% to 5%. And rent is way behind that when you go up to 8%. I mean, nothing cash flows really.
Right.
So the question is how long is that sustainable? Is it really going to drive rents up, or are people going to, the Fed eventually almost going to be forced to lower interest rates down to something that makes sense to investors, especially in a place like Oklahoma where the majority, not majority, but I think it was 45% last time I looked, were rentals in a lot of areas.
Right. Well, I've talked to some high net worth clients of mine, and they're commercial people, but they think that rents are on track to keep up with interest rate increases.
Okay.
That's their point of view. And so, but you know, the 10-year right now Treasury is 3.44, and I was told by a guy one time, when that gets over 10.5, it kills the housing market. Well, I mean, when it gets over 3.5, I'm sorry.
Okay, so we're nowhere.
I'm sorry, but when that gets over 3.5, it kills the market. Well, it's been as high as 4.5 in the last 90 days.
Yeah.
You've seen quite a softening, at least on the commercial side.
Yeah.
But,
Yeah, commercial investors have a little bit larger time horizon with rents because they have 3, 5, 7-year leases. The residential landlord, they want rent increases now every year. Yeah, yearly. So
And I can tell you firsthand, based on that is not keeping up.
It's not
but
happening,
nothing can keep up to what's happened
Yeah.
the last
No.
6 months.
yeah,
So if they stay or come down gradual and we continue to see the rent increases we've had in the last 18 months, then it eventually will get there, but it's not going to happen in the next year.
well, and another factor is supply and demand. And so I'm seeing, or at least I think I'm seeing, the beginning of a deposit crisis at banks. It's hard to get deposits. The Fed before was putting money in our economy, and how they do that is they buy bonds. So they pay cash and they bring in the bond, and that cash goes into the economy. And they were buying a lot of bonds, I mean billions a month. Now they've stopped buying them. So that influx of cash in the economy has stopped. And the articles I'm reading, I get newsletters every day, banks are scrambling for liquidity. Well, if they don't have the money to lend, their loan rates are going to go up. They may, their best customers, they may be doing a half over prime or 1 over prime rather than the prime rate, because they don't have to make the loan because they don't have the money to make it anyway. So anyway, so I don't know what's going to happen on that realm.
so it's not just driven by the Fed rate or the discount rate. It could also be supply of money.
Supply and demand of money.
Okay, interesting.
Yes.
So All American Bank right now? You said discounts at 4,
4.5.
4.5.
The discount rate.
Discount rates
The
at 4.5.
Fed.
Prime's at 7.5.
Right. It's 3% difference.
So what are you loaning out commercial money at right now?
Okay, well, it's been a mixed bag because rates are increasing so fast. So, but we said, okay, we're going to make 60-day commitments.
Okay.
So when the customer comes to you, so we make a 60-day commitment to that rate. Well, when the rate goes up 1.5 before you close the loan, it may be a subprime.
Yeah.
I mean, below prime right off the
Yeah.
bat. So it's been a mixed bag. Banks are all over the board. You know, when rates are stagnant, all the borrowers hone in, and the banks hone in what the going rate is. And but when rates are on the move, there just doesn't seem to be any logic to what's going on. I know
Just your comfort level, I guess, with the
I've
risk.
heard some banks are loaning at 7 right now. Well, prime's 7.5.
We got a loan yesterday at 6.5.
Mm-hmm.
On commercial? On a real?
5-year fixed 20-year.
Well-
I was blown away by that.
Well, what time horizon was it?
3
It
year.
closes in
Yeah, but it's
But it's
going to
a
blow
3-year log.
5-year loan.
Oh, 5.
5 year. So, you know, you look at the 5-year treasury, it's at 3.5, and the 3-month is at 4.6. So they're probably saying, okay, rates are going to come down, therefore we're going to price this lower.
So that was kind of my question is like, are you guys, so whatever bank that was, they're looking forward and trying to capture business today,
Yeah.
hoping that these people are correct.
Right. And so you said that was 6.5, so that would be 3% over the treasury
Gotcha.
rate for that time horizon.
Yeah, this particular bank lends off the treasury, not off prime.
Prime,
So
yeah.
it's 3 over. Okay.
Yeah.
All right,
So,
yeah.
but
Off the
compared
5 year.
to most banks you deal with that deal with prime,
Yeah.
that's a full point better, if not a point and a half better
Yes.
than
But
other banks.
and I had talked to a bank recently. We're refining one of mine, and I think they were 1.5 over 5 year was their margin.
Was the margin.
Yeah, and it was locked in for 5. So they're still tacking margins on, which didn't sound like that bank tacked margin on.
Just 3 over. That's what they've always said.
Three
Is
over,
three over the 5-year treasury.
Okay.
Okay, what if
Yes,
it's a
right.
3-year balloon? Is it 3 over the 3-year treasury?
I do not know because we always ask for fixed for 5 years.
Which maybe now we should start looking to fix for 3 if we
Potentially, yeah.
suspect the 3
Do you think, I wanted to get a question out there, do you think variable rate is
We
a
talked about
decent
this.
strategy based on what the market is showing?
The highest net worth people I deal with always want variable rate. They think they will save money over time because banks are hedging by putting a bigger margin in there. They don't know what rates are going to do, but if it's hooked and it's on a variable rate basis, the bank knows they're going to be fine.
Correct.
It doesn't matter what rates it is from a bank standpoint as long as they go with them.
Correct.
So banks will take a lower margin because they know they'll never be upside
Yes.
down on a rate.
They'll have to take a lower margin on a variable rate.
Are those like fixed for 1 month, like literally adjust monthly, or are they fixed for a year and adjust monthly?
However you set up.
You can do
Some is
anything.
date of change and
Okay.
others are repriced once a year
Okay.
in order to stabilize their payments.
Yeah,
as
yeah,
if
yeah.
They're adjusting the payments.
Yeah.
So, but even when rates were down in the 4s, were they still selecting variable?
Yeah, like New York Prime was 3 1/4.
Gotcha. So
So
they
they-
have
so they
lowered
were
it
getting
than a
3
lot of
1/4
people
for a
are
long
actually getting.
time.
Gotcha.
And their balance was much higher then. And,
Yeah. Because most banks wouldn't go below 4 1/4.
but
Just because it
you,
was so low.
you have these customers that are on variable rate, then they see rates are increasing, and then they
Yeah.
go, "Well, you need to take me off that, or I'm moving my loan."
Yeah. They want to
Classic.
ride the
Classic.
fall and get off on the up. Yeah.
Customers have all the advantages. So.
Yeah.
Oh, that's funny.
Yeah, that's good.
Good
So, how much like secondary market mortgages do you guys?
We don't do any.
Oh, you don't do any secondary.
Every 1 to 4 family, or whether it's
Okay.
consumer or whatever, we keep it on our books.
Okay, good.
Do you think rates will ever go prime? Will ever go below 5 again in the next 5 to 10 years?
Let's see.
Are you talking about New York Prime?
New York prime.
Oh, well, golly.
I'm trying to put it in a little bit more layman's terms for some people that maybe might be
Well,
watching this.
You know, if you believe the Treasury yield curve is a proper track
Historically, has it
to
been?
gauge that, 5 years from now, this is showing 3.5, and the 6 month is 4.8. So that's 1.3% difference. New York is 7.5. So no.
So no. So we'd be at 6.2. So let's call it 6 for round numbers, or 6 1/4. And then banks are making it half, so full over that.
Right.
Okay.
But you got to understand, prime has historically been hooked to the discount rate. So this yield curve is a little more stable than what the Fed can do. I mean,
Gotcha.
so
How and I guess this is probably baked into all this. How influenced by external factors, politics is a Fed rate now? Like if we get into, my big thing, my thought is next year is a election year. 24 is an election year. So economy is always the first thing everyone talks about. Are they going to artificially lower rates to pump economy, or is that baked in, or how much does that play? Am I just a tinfoil hat guy?
right. Well, there's supposed to be a separation in D.C.,
Sure.
but it seems
Are
like
they 2 blocks away from each other though?
Right.
Yeah.
And then certain people in there are appointed by the
Yes,
president.
you're right.
And it seems like in an election cycle in the fall, rates are always low or going down.
Yes, falling. Yeah.
Right before the next election.
Because of our leadership.
So I don't have any proof that they don't talk,
Right.
but most of the people I talk to think that whoever's in charge of the Fed is trying to help
Yeah.
the next president
Gotcha.
if they agree with him.
Yeah. Okay. Yeah. Right. Small bias there potentially.
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 but
Off
I
the
don't want,
record.
I don't want the law coming after me.
Yeah. We're just talking.
But it seems like rates are always lower or going down.
Going into an election.
Going into an election. Presidential one in particular.
Yeah. So, okay. So how can we use this? I'm trying to think how we can apply this now that we kind of have an idea of it. I mean, it looks like it's falling. 3 and 5 years, we can expect lower rates. So would you want to do a variable, or would you want to lock stuff in for 3? I mean, 3 is the lowest unless you do a variable, right?
Well, you remember you can always put ask for a ceiling on a variable.
Okay.
And if you ask for a ceiling as a borrower, you should probably say, well, you need to put in a floor.
Yeah. Yeah.
You know, or the bank may be asking for a floor,
Right.
and then the consumer needs to ask for a ceiling. That's how that works.
Yeah.
But you know, I don't want to do one thing and do it. Right now, I have loans at a variable rate.
I was about to
And I
ask you.
still have
You own property. What are yours
And
at?
And I could pay them off, and I haven't. So I'm expecting to ride that back down.
Okay. And you're keeping it variable through this peak, assuming it's going to fall again over the next 24 to 36 months. Okay.
Gotcha. Well, I have one more question, which is in regards to mainly what we do, which is the 1 to 4 family sector. When rates go back down, just being what you've seen on the loan side of things, where do you see prices going? Because right now, just to tell you, we're getting a lot of houses, a lot more inventory, a lot more to look at, and they're significantly cheaper than where they were not 6 months ago.
So you're seeing cheaper houses.
We're seeing more equity come across.
A lot more equity.
Yeah.
Now, cash flow is
Yeah.
way worse,
Yeah.
simply because of one thing, being the interest rate,
Right.
obviously, where you can get your loan at. But, so just for like my clients will understand this, our average house that we were selling to our clients was roughly $13,000 or $14,000 out of pocket at an 80% loan to value. That's what they're going to have to come out of pocket.
Okay.
And now our average house that we're selling is about 4. So we're getting that same house based on the same remodel, same everything, $10,000 cheaper across the board. It doesn't matter if it's a $200,000 house, $100,000 house, $150,000 house. We're not up high. We're not usually buying $300,000 houses. Every single one of them is $10,000 cheaper.
Wow. What about the remodel cost? Is it more expensive?
Well, it's simply only more expensive due to inflation and labor costs. But we're still factoring that in. So remodel's gone up just a fraction, not a ton to be honest, maybe let's call it 10%. So our average remodel is $30,000. So really if you factor that in, we're actually getting every house about $13,000 cheaper than we were just 6 months ago, 7 months ago.
Wow. Okay, that's the first I've heard about that drastic of a change. But, you know, if you buy a fixed rate bond and interest rates move, the price of that bond is inversely proportional to which way interest rates are going.
Yep.
So if interest rates go up, the bond's worth less. Right. If interest rates go down, the bond's worth more. Same with houses. If interest rates go up, there's downward pressure on the value of that house, but there's a lag because the sellers, it takes them a while to catch on.
Yeah.
It's a slower process than just a bond, which is so liquid and fluid. But yeah, there's definitely, now when rates go back down, there should be upward pressure on the value of houses.
Correct, but what I find fascinating, and I think he'll back me up on this, is houses under 250, especially under 200,000, there's no difference selling it on the MLS. They might sit there a fraction longer in days on market, but the actual prices they are selling at hasn't hardly changed at all if you're under the $200,000 mark.
Well, that means there's a lot more buyers in that arena. There's a lot more competition.
Correct, but I'm wondering what's this pressure that's forcing. The only thing I can figure is they're not on fixed mortgages, or they.
You talk about the ones you're buying.
The one we're buying from sellers that are off market.
Oh,
I think
because there's been a huge difference there.
So my opinion would be that the stuff you're buying really has to be purchased by an investor. Investor is driven tremendously more by cash flow versus a consumer buying a home is driven by their buying power, their rate also, but they're going to live in it. They don't need to cash flow it.
Yeah.
So there's a sunk cost of ownership there versus needing cash flow. So they can't put those on the market because it's the same buyers are going to buy it, investors. Versus a renovated home, a homeowner can move into it and they don't need the cash flow. As long as it matches their monthly obligation, they don't care what it costs.
Yeah.
So people are losing buying power, but that means they have to buy a 250 house instead of a 280 or 300 house.
Correct. On your side, I'm confident that is the answer. I'm still wondering though why that on our end, why we've seen such a drastic change so fast. I mean, this really started happening in December.
Yeah.
So it was almost exactly that 6-month mark when it started happening. I mean, us as a company, I think contracted 2 or 3 houses in all of November, in October. And then when we saw in November, it's like the floodgates opened. Into November, December, and January, which are usually our slower months. Yeah. Not only were we getting more inventory, but consistently that inventory has been much cheaper.
So, to be clear, you're buying houses from investors.
From
homeowners.
But
they're distressed homes.
They
require renovation.
Correct.
Which the average consumer is not.
Our average remodel is about $30,000 to
Wow.
get it to where it would be suitable for the MLS.
There's kind of 3 places a house can be priced. Price it low, or an investor can get it, and there's meat on the bone, because an investor is an investor. There's the middle, kind of no man's land, where a lot of people put their stuff on the MLS, where there's not enough meat on the bone for an investor, but it's too much work for a consumer. And then there's the consumer, where you price it for the consumer, and the consumer buys it, and you get multiple offers because it's a beautiful home or whatever. So I think you're buying the stuff down here where a consumer has no business, and there's meat on the bone, because no man's land's always been, no one sells something, it always sits on the market. And then.
So do you think investors aren't, why we're seeing more if you are an investor, is simply due to interest rates?
Yeah, but their ability to cash flow the property has been driven up. Yeah, right. So,
but if you play the future game, you're still buying the same house, $13,000 cheaper. It's the same brick and mortar. That house didn't change or pick up and go anywhere.
Yeah.
But if you kind of play the game and no one knows the future, but you make predictions off what we talked about with the market and stuff, and then reprice it at a lower interest rate and rents come up, you got the same house for a lower price that eventually will cash flow, but you have to ride that wave while it's not cash flowing, and do you have the cash to do that is the question.
Yeah, right. We call that feeding it.
That's what I heard. Someone told me a while back. I asked an investor if they buy properties, if they love the area, love the property, love the equity, but it's not cash flowing. And they said, that's not investing, that's speculating.
Yeah,
and that's
a great way to say it.
That's true. I'm speculating that rates come down, that I pay down, that there's appreciation, and that it cash flows in the future. But yeah, that's speculating is a type of investing. So if you can cash flow it, if you have a portfolio that can cash flow it, it's a different type of investing. Banks don't like to see a negative or below a certain debt service ratio, but it's a type of investing.
It's either cash is king or cash is trash.
Yeah, depends on who you are.
It is and where during the cycle.
That's what I've learned is there's no right. It's just what's your situation right now. And I've been in a situation where I'm trying to buy as many things as I can, and cash is king because I need to fuel the machine. And then there's periods where I'm not, and I don't want the cash. I want to put it into the debt and let it cash flow. And it depends on where you're at in your investing career.
So the ultimate question my investors are asking is, do you buy now when the prices of houses are so much cheaper, quite frankly, for what we can get it for? And I want to clarify one thing, but they don't cash flow versus when investors are buying really for the last 3 years, honestly. Most things cash flow, but you're paying more for the house.
It depends on if there's going to be a deep recession or not. And I think it depends on which pocket you're in America. Are you in Chicago, Oklahoma City, Miami, Austin?
Well, let's hone it into Oklahoma City. That's the only place we got investors.
So I hear these talking heads on TV, and the government was putting a lot of money in the economy. They were spewing money across the hillside, and I've been told, and I don't know how these smart people know this, that there's $1.5 trillion of cash in bank accounts across America. And because of inflation, that money's going to be gone midsummer.
God.
And when that money's gone, they they always say things like there may be a deep recession or there might be a deep recession, but they're concerned about what may happen this coming summer.
You're saying summer of 23.
Mhm. And so you may want to wait and see, because I asked another guy one time that was really smart. I said, after a recession, how do you know when it's time to start buying all the cheap stuff? And he says it's about a year and a half after you see the banks starting to foreclose property. I thought, boy, that sounds like a long time, but you know, time flies, you know, when you have fun, I guess. But,
So you're saying prices might go further and further down for the next 2 years?
Yeah, but we're seeing something we've never seen before, and that's this great migration from the coast
To
and
Midwest.
so, you know, we're having population growth. Well, what causes trouble in the housing market is when you got a lot more sellers than buyers. Well, right now it's opposite, and if people keep coming in out of the higher tax states or for whatever reason, if they keep coming in, there may never be a
Yeah, it's essentially going to insulate us.
Okay.
Coast might have that problem,
Yeah.
but not here.
And that's
Right.
at the end of the day, that's what drives real estate market, supply and demand. That's what makes a buyer's market versus a seller's market. And then the supply and demand of money is a factor. That's what caused prices to go through the roof in '08. Everyone had money, everyone had buying power, everyone bought second homes, vacation homes. Now it's a supply of buyers, not necessarily money. Money's tightening up, or as tight as it should be probably, but there's no supply of housing. And at least in Oklahoma, I think it's that way. I think we're still several million houses short from a healthy real estate market across the country. And so, as long as supply stays low, I don't know how prices could fall, because there's still people moving, still people having babies, getting married, being born, downsizing, retiring, all these things that drive.
Especially under a certain price range.
Yeah, especially under a $250,000, $300,000 range. So there's still just built-in market demand that we can't even provide. And so I think, and another thing I saw recently, kind of almost to a counterpoint to what you said, in every recession for the last 100 years, except for the 2008 recession, because it was housing cost recession, the price of housing has gone up in every recession over the last 100 years. And I guess it acts more as a commodity than a.
You must not have been alive during the 80s.
What was that now? So you're talking like the oil or the.
Yeah, well, it was an oil attached to inflation.
Okay.
Carter was president, and then.
Yeah,
Reagan.
so over a 3-year period,
Yeah, we had people leaving their keys to their houses in our night drive. And there wasn't any jobs.
yeah.
And so people were fleeing the state, and prices were going down. And residential real estate went down 1% a month for 3 years. Went down
Nationally,
in Oklahoma City.
just Oklahoma City. Okay.
35%. No, it didn't happen nationally. Commercial went down 50% in Oklahoma.
Okay.
But it was the great exodus of these oil workers,
Okay.
and our economy is much more diversified. I don't see
So
that happening.
So that was real isolated to our local economy then.
Mhm.
Okay.
Yes.
So that statistic I
Well,
quoted
in
did not
Texas,
factor for that. I
well,
suppose.
Texas. I mean, the oil.
The oil, yeah, okay. Oil, yeah. Okay.
It was essentially the exact opposite of what we're seeing right now.
Yeah.
Everyone
People
coming in.
versus leaving, yeah.
And leaving,
Right. Yeah, we're seeing the opposite.
Yeah.
So
Okay.
I asked. Well, once again, I talked to these smart guys.
Yeah, good.
And how I know they're smart is they have a lot of money.
They're winning.
And I said, are we in a bubble in Oklahoma City? And the one guy that I specifically asked that question to, he said, no, we're in our lane.
Mm.
He said, we're not in a bubble in Oklahoma City. We're in our lane. I said, okay, that's all I need to know.
Yeah, when you look at, DFW is obviously 20 years ahead of us, maybe, as far as growth and economy. But other Midwestern, Houston, DFW, Kansas City, they're all so far ahead of our growth of population and real estate prices and all that stuff that there's clearly continued opportunity across. I don't think we're anywhere near. You look at price per foot across all those areas, we have room to grow, I think, because our population's not growing, or not shrinking, it's growing. We're bringing new industries into Oklahoma City. I think Oklahoma City will have a supply issue for until we build our way out of it.
Mm.
And we're not building. Building's gone down like 60% since rates have jumped. So we're a long way away from building our way out of our supply issue.
Do you know why there's a shortage? I mean, other than the Great Migration, the United States built very few houses over the last
20 years.
Yeah.
Yeah. So, or
I
after.
find it fascinating because I look at comps every day, and I know you look at comps a lot too. And there's always like, you find all these neighborhoods all the time, and it makes up square mile after square mile after square mile, and they're all built, let's say 80 to 85, or even way further back, 20 to 30. It's like the whole city was built in 10 years
Yeah.
to a certain point.
It
And then
exploded
there's
in the
just
90s, yeah.
nothing except for this, oh, there was a random neighborhood put in the 40s right there.
Mhm.
But that's it, not square miles worth of houses. So I find it interesting looking back just from comps. It's like, all right, you can clearly tell after I've looked at literally hundreds, maybe thousands of houses, there's a ton of built right in this period, and then nothing.
Yeah.
And then a huge amount built in this period, then nothing.
Mhm.
And I just, I generally look at stuff built before 2000 because it's got to go through that period before really it's a rental.
Yeah.
Which is what we're looking for.
Yeah.
I sent out the first house to our investors, funny enough, today that I think I ever have that was built after the year 2000, just because they got to have that period where they change owner hands a few times before you can buy them at a discount.
Yeah.
Exactly.
Yeah, well, and don't you think jobs drives that? Because if
Yeah.
there's jobs, people will stick around.
Yeah.
Look at our unemployment rate, how low it is. I mean,
Yeah. Oklahoma's.
It's
Yeah,
so hard
I
to
mean-
find people.
it's going to take a long time to
Mhm.
get
To
the
flip.
unemployment rate up, I would think.
Yeah.
In the last 2 years running my company, I've had to increase our minimum pay by about 30%, just to get anyone to
Just to
interview.
be competitive.
It
Yeah.
wasn't hiring. That was a whole
Yeah.
different thing.
Yeah.
That was to get someone to walk through the door.
Yeah.
And then you got the same thing overnight. I felt like that I was getting when I was 30% lower. It was the same person. It wasn't anyone
Oh,
more
yeah.
qualified
Not a more skilled
whatsoever.
worker. Yeah, it's
No,
not a
it
more
was
skilled
the
worker.
same
Yeah.
person.
Yeah.
So what does that tell you? I mean, the inflation has just been wild, and unemployment's so low that it's just so hard to find someone that just wants to do
Yeah.
some form of work.
I think there's a lot of what do they call it? The gig economy. People making money on the internet. People being able to work from home and live here instead of in Dallas or California or wherever. So our low cost of living, which is low nationally, it doesn't feel low to us. We've been riding the wave, but there's a lot of things that are allowing people to continue to live here and continue to be employed and earn money without jumping jobs every 12 months.
I will say I've seen that settle down. I've had the smallest amount of turnover the last 6 months. Then
I think uncertainty in the market causes people to be a little more satisfied
I
with
find
their
that
job.
fascinating as well.
Yeah.
I don't know what you're
Wait.
seeing at the bank, but
We've been casting the net out for loan officers
Mhm.
in our Oklahoma City. And qualified candidates were few and far between. The last net we cast out, we had what I thought were 3 great candidates. But interestingly, they were all employed,
Mhm.
but at other banks, and some of them, or 2 out of the 3, were in the mortgage industry.
Mhm.
So I think they may be seeing a slowdown.
They're-
because these mortgage brokers
They're
are
seeing
on commission.
They're seeing a
massive.
ton of
I just
slowdown.
hired someone that originated mortgage.
Yeah, and
ton.
one of those people said, "I'm seeing a lot of layoffs in the banking sector
Yeah.
right now." So.
Yeah.
Fascinating.
I don't want to make- couldn't remember it. Yeah, the secondary market mortgage conforming loans are getting crushed. They're starting to see more uptick, more applications come in, but they
Well-
got crushed for a 6-month period.
Look at the 10-year treasury.
Yeah,
If it's below 3.5, according to that one guy I'd never met before,
hurts it.
you'll have a lot of mortgage loans. But if they go over 3.5,
so
they're right.
they won't.
I saw there's a company called Keeping Current Matters, and they kind of educate real estate agents on the market and stuff. But they did a video about how over the last 50 years, I think, the typical secondary market mortgage has been about 1.8 margin over the 10-year T-bill. The last 18 months, it's been like 3.7 margin. Because of volatility, the secondary market, in order to increase appetite for secondary market mortgages, had to build that margin because they didn't know where the T-bill was going and everything. So that's what's causing rates in the 6s and 7s in the secondary market, 30-year mortgages. So once that deviates back to the mean of a 1.8 margin, we'll see ourselves back in the low fives, something like that. So the secondary market will get back to the low fives. You'll still be able to buy points or do buy downs and stuff like that. And I think we'll, at the end, I thought it was middle or end of 23, we'll see rates get stabilized, hopefully. As long as, if there's no risk of the Fed bouncing 75 basis points every couple of months, then it can begin to stabilize and people can have confidence. Just like you said, if I start shopping for a home and my rate's 6, and by the time I find a home, my rate's 7, that's a huge, that kills buyer confidence. And so once it stabilizes, margins can fall back to a 50-year average. Buying power is going to come rushing back, I think, and we're not going to have the supply still for it. So that's how I see the retail market going forward.
Yeah.
But I'm also seriously vested in the retail market, and I see rainbows and hopefully butterfly.
Yeah, I mean, that's all of our investors too. So I have one last question, which is, based on what you know about the market and what we've seen in the past, when would you buy?
There's never a good time to buy. There's never a good time to build a house.
History tells us there was a great time to buy in certain pockets. You just don't know it until it's passed.
But, I've built a house before just to live in, and there's never been a good time to do it. If it isn't sheetrock, it's higher, and expensive, it's something else. It's lumber. And
well, more specifically, would you be buying, based on what the past has told us, in a raising rate environment, when the rate's high, when the rate's really low, due to cash flow, when it's on the way down? When do you think is the best time to invest in real estate, regardless of what it is, 1 to 4 family, commercial, any form of real estate?
I think the best time to invest is when the property cash flows. And secondly is when it's a depressed market.
So we have one and we don't have the other right now. But
I think those are the best times to buy.
That's an ideal time to buy.
That's an ideal time to buy. Which the last time I remember that was roughly 08, 09, before I quite frankly really knew what I was doing. But the market was depressed and you could easily cash flow.
And you started, when did you start doing management? 11, 12?
13.
13, that's right, we bought our losses together.
Well, we may not have a depressed market in real estate for a long time. Now, it's depressed from the investment standpoint because it's not cash flow.
Correct.
That's what you have to remember is everything we're feeling right now was manufactured by the effects of COVID. People being forced to stay home, forced to leave the jobs, forced to not sell their house, forced to not, it's just kind of, it wasn't natural causes of the market. And we're still kind of feeling what's natural and what's an effect, a hangover effect, I think. And so, yeah, I mean, we've also had what would that be? 13-year bull market that's never existed either in the history of America. But I don't know. I don't know what could bring it back down. That's not artificial, I guess. That makes sense. Caused by man, I suppose, or whatever.
Who would have thought a boat would be a good investment back there?
Yeah, a car increasing in value over a 12-month period. A boat, yeah, none of that. I mean, yeah, you bought a vacation home in 2020, you could make a 40% increase in value on it if you bought it. So it's just not, yeah.
We have bank vehicles and we reevaluate them every year for tax reasons and 1099s for personal use. One of our vehicles had 150,000 miles on it. It was a Suburban, and it went up in value $7,000 from the prior year. Well, from the prior year.
Yeah.
We reevaluated every year, but I mean, it was like 5 years old, 150,000 miles, and it went up $7,000. That's value in 1 year.
Nice.
So we're in a strange time.
Yeah. Yes.
And hopefully people have the experience to navigate it.
Mm-hmm.
Because if it's always been good times all your life, you let your guard down, at least you tend to.
Yeah, that's one investing I'd heard in reference to investing. When times are good, people never think they'll be bad again. And when times are bad, they think they'll never be good again. And so if you can invest with a little bit of future in mind, and that's my, to kind of answer your question, if anyone cares about my opinion, I would think there's never, this is my whole investing strategy was there's never a bad time to buy as long as you know what kind of exit strategy you're going to have. Kind of start with the end in mind on the property exit strategy, and then have whatever you need for that. But when I got my real estate license, I knew I wanted to invest. So I'm working with a bunch of investors. I'm looking at all these deals. I'm underwriting every deal I sell. I underwrite it as an investment, and I'm thinking, man, none of these are really that good. They're all just kind of deals. They're almost deals. And then 2-3 years goes by, and that investor calls me back, says they want to sell. 40% increase in value. They've been cash flowing. It hadn't been vacant once. It's just like hindsight's 20/20 on everything, but time is going to make every investment a good one. You can just, I think, if you can
stomach it,
if you buy it correctly and you can wait long enough, and time will make most investments worth it. But what happens in that time? Can you stomach what goes on personally in your life, financially, all that? So if you can buy it correctly, just like now, cash flow's terrible. Exit strategy is good because we got more equity now if we need to dump it or do whatever. So that's my thought. I'm just, you just have to make sure you're in a good position to buy it, run it, manage it, and then have the exit strategy on it would be my thought.
Yeah, I've never bought a piece of real estate
You're upset about it?
that I'm frustrated with.
Yeah.
You know. Yeah. Now, if I were truly to flip it instantaneously, that's the risk in my opinion. But exactly what you said, you hold it long enough, it's always worked out to the green.
Yeah.
You know, it's always been good,
If you
even
can
with
hold it
repairs.
Yeah.
And big repairs. You can't have infinite bad big repairs.
Yeah.
I mean, a sewer line should last you longer than a year before you have to drop another $8,000 on it.
Eventually, you fix everything on the property.
But yeah, so I've never bought something bad. So it's always fascinating to me talking with multiple investors about. That's why I asked you the question. Should have asked you the question. Sorry, which is when is the best time to buy? Obviously, when it's cash flow and when the market's down, it's the best time to buy. But I don't know if we'll ever see that in Oklahoma City again. I don't know with everything we've talked about, influx of people,
Be a while.
interest rates. I mean, it could be a long, long time. So then how much money are you making sitting on the sidelines for the next 20 years waiting for that to happen?
So that's what,
Zero.
When I first got started investing, like a lot of people, I found like bigger pockets and all these gurus on the internet, and they're like, buy a house and cash flow $600 a month. And I'm like, where are these deals? And then you realize like, okay, they got started 5 or 8, 10 years ago.
Yeah.
Okay, well, all those deals might be cash flowing. You pay down, you refi, you manage it properly. Yeah, so
you don't walk in with $600 cash flow.
You just can't.
Let me say this. Every deal when I first started banking, I'm like, boy, I wish I'd have got in on that 5 years ago.
Yeah,
every 5 years I'm going, boy, I wish I'd have got in
That's
on
exactly,
that 5 years ago.
that's exactly.
So there's always another cycle of
Yes.
Correct.
something coming up that you're going to wish you'd gone in.
But it's convincing the new investor
To get in
of
now.
that.
Yeah.
That's my hardest part of my job, in my opinion. Whether it's signing up a new client that's not to invest. That's to really say they're going to invest at some point, right?
Yeah.
I've taught 5 or 6 clients that have never bought a house.
Yeah.
They know about it, but it's still taking that plunge. And then once you take the plunge, it's continuing to take the plunge because then they get nervous when the first 2 or 3 and then all this market stuff going on. It's like, hold on, let me slow down.
Yeah.
But I guarantee you 100% of them 5 years from now will say, boy, I wish I bought more 5 years ago. But that's so hard to know if you're beginning to invest in real estate.
And it took me 5 years in the industry before, we finally met up. Perfect timing. I just kind of started. I just started my investing career, but it took me 5 years to realize, like, same thing. Every deal I looked at for the last 5 years would be a home run if I owned it right now. But I didn't buy any of them, right? But I didn't buy any of them because they weren't good deals or something. And so I think a lot of people might stay on the sidelines waiting for that $400 a month cash flow deal to pop up. That's nothing out of pocket. It's like, man, they're just not.
There's never a good time to buy.
Never. You're going to have to
You
create
just got
that.
to do it.
Yeah, exactly. So.
And the biggest mistake you can make is, if you've decided to go in that, is to quit buying.
Yeah.
I've talked to builders who are going, man, it was harder getting started the second time around. I shouldn't have quit building. I should have just scaled back, but continued to build. So anyway.
Yeah, that's what I'm doing. Scaling back, continuing to buy. No, it's not quite the pace.
Well, thank you very much.
Yeah, this is very helpful.
Welcome.
This was great.
Welcome, yeah.
I hope this was valuable for anyone who, if anyone watches this, it might just be frustrating. I had fun. So, all right, well, let's wrap it up. Hopefully you guys enjoyed that.